So is that it? Is the bull run over? I mean, the bulls had a couple really good weeks there around the 12-day Israel-Iran war, and then everything came crashing down again. And the bulls did not have a good week this week, even though there's plenty of bullish stuff still going on in the market. But let's talk about that this week in oil. Hey, I'm Aaron with over 30 years of experience in oil trading and analytics, and I'm here to elevate your understanding of the oil markets. So let's dig into this. All right, so here's the chart I was mentioning. We see the big run up here on crude oil with the Iran Israel hostilities, and the market came right back down. Then we had two pretty decent weeks in a row where we were able to bounce off of these support levels and end up above them. But this last week was just not pretty for the bulls. And now this is a weekly chart that we're looking at here, but keep in mind that 4 out of the 5 days this week we had down days, with Thursday being the only up day. And then Friday, of course, had the lowest settle of the entire week. Not the lowest low, but at least the lowest settle of the entire week. So that's not looking great. And as this support line drops away, next week's support is going to be in that sort of $64 to $63.50 range for next week. Now, again, I think ideally for everybody to keep on going, for the producers to keep producing, for the end users to still be happy, we probably need to get up here to that $70 area, where if you look, it's the very top of where we got to during last week. We got up into the high $69 range last week. I still think that's sort of the Goldilocks price that the market needs for everybody to sort of be happy. And that's going to be hard to achieve. Like I said, there's still some bullish things going on in the market. We're going to talk about those. But again, this chart is not looking great for the bulls. On the other hand, on the distillate markets, at least they tried to break out above the Bollinger Band. These distillate markets have been very strong. On Thursday, again, the market was quite strong. Friday, it came back off a little bit, and we'll talk about that here in a minute as to maybe what was going on in the background with that. So distillate markets are at least pulling their weight. They're keeping the margins strong, the refining margins strong, and keeping things going. But again, if we lose sort of the bullish support from the heating oil market and the WTI crude oil market, bulls are going to be in a really tough spot. So crude stocks are still low, as I've been mentioning. Last time we talked about distillate inventories being low. This time I want to talk about crude oil stocks being low. So even on the national level, inventories are still just below the bottom of the 5-year range here. In pad 2, this is the Midwest. Inventories are below the 5-year range. If you go to my website, theoilbalance.com, I can put you on, or you can click the button that says add me to your distribution list. In this week's report, I go into much more detail about these crude inventories and sort of what the implications are and what all that means. But for this video, I just want to point out that Midwest stocks are below the 5-year range, and pad 3 stocks, Gulf Coast stocks, are at the bottom of the 5-year range. And again, that's where most of our refining capacity is. So to be at very low inventories in these two combined locations is not good at all. Especially going forward, we still have a lot of summer to get through. It's only, the middle of August here. So again, from a fundamental perspective, we still should be getting some support, you would think, from these inventory numbers, but that's not what's panned out in this last week. Remember, if you like this sort of thing, please like and subscribe to this video. It lets the algorithm know that you like this sort of thing, gets it out to more people, and I would really appreciate that. The other thing I want to sort of get into real quick is what we call the value proposition of WTI. So I've talked about this before. If you look at just the sum of the parts of WTI for like some of the Gulf Coast assays that we have for WTI, and you multiply that through the atmospheric cuts. So basically the NGLs, the naphthas, the jet kero, the middle distillates, and then the heavier ends. You multiply those through by their values in the Gulf Coast, and you get some sort of idea of what that crude is worth. So is the sum of the parts worth more than the crude is today? And that's what this orange line here being positive, that's what that means. The sum of the parts is worth more. So it makes sense for the refiner to buy that particular crude grade and refine it, because he's going to make money just off the first basic step of refining, which is the distillation column. And then, of course, the more complicated upgrading units are going to make him even more money after that. This blue line, though, is looking at the arbitrage potential from Houston to the North Sea. And so there's a very active market. There's somewhere, call it between 1 million to 1.5 million barrels per day being exported that goes to the North Sea out of a 3.5 to 4 million barrel per day overall market. Things have been a little bit slower here recently. But this is one strong indication, again, that the value, at least on the offer side of the market for WTI in the North Sea, is actually profitable. So we've seen a couple things. We've seen the freight rates actually go down. So the what it costs to actually get the ship and load it up and move everything over, that cost has actually gone down. The TI Brent value has gone down, so Brent's stayed at a higher value than WTI has on the futures. Basis markets haven't been really doing that much either. In terms of the Gulf Coast, they've been actually weakening a little bit too, on top of the weakening in the futures value this past week. So we're really seeing just a drop in the value of these Gulf Coast, especially in the Houston area, WTI values. Retail prices, though, are still hanging in there. As I said before, the diesel market's been very strong, and you can see that we've kind of popped up here recently to sort of year-ago type levels on a national average. So nothing crazy. We had been trending pretty far below year ago, and then last 4 weeks or so, we've sort of caught up. Gasoline's been very flat. If you look at that, not a whole lot of deviation in price this year on a national average, and we're still below year-ago type levels. So that's still looking pretty good. And demand, we'll talk about that in a second here, but again, we're not seeing really any headwinds in terms of demand from prices like you might expect, because we're just now sort of getting to year-ago type levels. And when you're slightly below year-ago type levels, that does give you a little bit of a tailwind, although it's not a huge amount. So let's kind of go through the different concerns I have, at least in my head, of what's going on in the market right now. So on the bullish side of things, you have really low inventories with crude oil and distillate stocks. We've got hurricane season coming up. I think on the NOAA, you can actually see another place that they're looking at. They're only giving a 10% chance right now of formation, sort of off of Venezuela. But that time is coming, right? We are going to get storms in the Gulf of Mexico. Whether they do anything or not is a different question. But at least that's going to give the market a little bit of something to work with, give the bulls a little bit of something to work with. The Mars specs and the SPR swap. So I saw a lot of people, maybe not a lot. I saw several commentators on YouTube making this out to be a big deal. I actually don't see it as being that big of a deal. Chevron was trying to tie in a new field into the system that brings the various grades that they blend into Mars. So Mars is actually a blend, and there was too much zinc in that blend, I guess, from Chevron's new field that they're trying to tie in. And so Exxon at their Baton Rouge refinery said, we're not able to take any more of this. We need help. So they reached out to the DOE, who they do business with all the time. And they came to an agreement saying basically that Exxon could borrow up to 1 million barrels and then they'd have to return it at some time in the future. I didn't see the details necessarily about when and the how, but the DOE, the statement from the DOE did come out and say that it's not going to cost the taxpayers anything. And, so again, I saw some people online making this out to be a huge deal that Exxon was borrowing barrels from the SPR. That's not such a big deal. It happens from time to time, especially with situations like this, where either a certain refiner in close proximity to the SPR sites is unable to get the crude they need for whatever reason, or the crude is, like in this example, it's off spec and would damage the refinery if they continue to run more of it. And so the DOE is pretty flexible about saying, okay, borrow it now and give it back in 2 months' time or 3 months' time, and we'll all move on. So out of, we've got just over 400 million barrels in the SPR. If Exxon needed to borrow a million barrels to get them past, uh, a short-term issue, that shouldn't be a big problem in the market. But I did see people out there sort of making it into a bigger deal than it is. And it sounds to me like they've already got it sort of figured out in terms between Exxon and Chevron, and that one report I read said that Exxon had only taken 300,000 barrels out of the SPR instead of the full million that they were sort of given permission for in the beginning. Maybe another big deal, and probably what is behind some of the strength in the distillate market, is the Bayway refinery. So this is I guess it's the last refinery in New York Harbor. It's got a huge cat cracker, which is primarily made to make gasoline, but you also get some diesel off of that as well. And with diesel inventories being so low, especially in Pad 1B, which is that New York Harbor area, I think it makes sense that distillate got a little bit frothy on that. Again, as those rainstorms that we had last week moved through the country, they caused power outages in that Bayway, New Jersey area, and power outages are no good for refineries. That really takes them out, and especially in terms of trying to restart from an unplanned outage like a power outage, trying to get the cat cracker back up and running is probably one of the more complicated units to do that. There's a lot going on there that could cause issues. So we need to keep a close eye on making sure that FCC, the fluid cat cracker, comes back up at Bayway. It looks like everything is sort of starting to get back to normal now. So I'm still putting it on this list as a potential bullish concern. Hopefully by next week, it'll be sort of a non-issue. And then, of course, geopolitical risks that we still have to talk about. There's a lot of different ways that the various wars going on in the world could flare up and impact the oil market. So, as we just saw with Israel, Iran, hopefully that won't be repeated anytime soon or at all. But that's sort of the thing I have in mind, putting down geopolitical risks here. On the bearish side of the equation, though, if you look at gasoline demand, it's actually down a little bit year on year through the first half. And again, I'm primarily looking at the weekly numbers to get us there. The monthly numbers we don't have through the first half just yet. That's not a huge surprise. So the STIO, so the EIA actually puts together a forecast, and it's actually been pretty good here lately, of sort of their supply and demand and what they think's going on. And so that STIO forecast did actually in Q4 of 24, which would sort of guide your outlook for Cal 25, did have gasoline slightly lower. Gasoline demand is doing a little bit better than that. It's not positive, but it's not as bad as the STIO forecast had it out to be. And again, it's not terrible in the first place. But for more information, you can always go to my website, hit add me to your distribution list, and I'll send you the packet, which explains a lot more about this particular issue. So that's a concern. That the product that should be leading the market higher. This is driving season. We're actually seeing inventories grow. Demand is a little bit soft. It's not terrible. And that is probably weighing more on the market than some of these other things, on the bullish side of the market, especially since we don't have any hurricanes in the Gulf right now and that sort of thing. So anyway, back to bearish indicators that I see. Obviously, the technical failure on the charts last week, the first chart we talked about here, not a good sign. Breaking that support line. Crude basis markets grinding lower. Again, in the full chart pack that I put out, you'll see in detail what I'm talking about, but just know that Midland, Houston, and even the X-Pipe markets in Cushing, all those basis markets are going lower at the same time the futures were going lower. So it's kind of compounding the loss in value or the decrease in value over this past week. And then low crude exports, which I think should get sort of resolved with the previous chart I showed you about the ARB starting to open back up. And then the OPEC overshoot. So again, what we're talking about is OPEC keeps coming and increasing volumes to the market, which is great. and it probably means demand is doing better than we thought, or at least from a International Energy Agency standpoint, is probably doing better than what they thought. That they're able to sort of, whether they're just justifying cheating or whatever it is, the point is they're not trying to take barrels off the market yet. So that's sort of, in my opinion, still a net bullish thing, that the market's absorbing those barrels. However, just seasonally, they're going to come to a point where refining demand starts to slow because you go into seasonal maintenance periods. And that's where OPEC has to be very careful about how they handle that. So are they going to take barrels back off the market in the calendar months of September, October, November, and then try to bring stuff back for Q1? That would make sense to me. Let's see what they actually do. So in other words, time is running out. So I'm still somewhat bullish on the market, just sort of based on these issues over here. But my time is running out, right? Hurricane season is somewhat limited by the end of September. They're pretty much done in terms of the really intense storms that come through. Again, we'll see. Mars and Bayway should be figured out by then, definitely. Geopolitical risks and low inventories could probably still be a concern between now and then. So we'll see on those issues. But again, if OPEC continues to just put all these barrels out there in the market without pulling anything back, that's how you serve this number one concern of mine on the bullish side, is low inventories, at least on the crude side. Hopefully domestic demand for distillate stays strong, and it was super strong in Q1. It was looking pretty good in Q2. So net for the first half of the year, things are actually looking really good for distillate demand. So we'll see what happens here in the second half of the year, how things go. With the geopolitical risk, we could probably also talk about the tariffs and the potential impact on diesel demand and train demand and that sort of thing too, if depending on how those situations end up playing out. So that's sort of the short video for this week. Are you guys bullish? Are you bearish? What are you thinking here? We're getting into sort of a quiet part of the year where the Americans are starting to take vacation time. Europeans are going to start taking vacation in the month of August. The market's probably going to slow down in terms of volume a little bit, but again, that's a double-edged sword, because if something comes out, if somebody has, an axe to grind, something they need to do, they can move the market quite a bit in those periods of time where the trade volume's a little bit lower. So should be an interesting, 6 more weeks or whatever in the market here until we get to this transition period at the end of the summer. So what do you guys think? Is the bull play over? Where's the next set of buyers going to come from? Is it going to take some sort of geopolitical event to get buyers to come back in this market and take it back up to that sort of $70-ish happy place that I think the market should be? Again, just for fundamental reasons. Let me know what you think. Please put it in the comments below. Again, if you like this sort of thing, please hit like and subscribe. And hopefully I'm setting you up for sort of a good week ahead and bringing these things back up to discuss with you. One last thing I want to talk about too is if you need some help in hedging, or at least talking through what your overall situation is, maybe there's a way that as an end user, we can figure out how to put on some hedges. I'd be happy to discuss that sort of thing with you. Again, just go to my website. If you hit the add me to your distribution list, it'll pop up an email, and you can detail those concerns, and we can get in touch and talk about that. But just thought I'd put it out there. I've been talking with a couple other people about that sort of thing. So, wanted to extend that to everyone here as well. So anyway, please like and subscribe. Hope you like this video, and we'll talk to you later. Have a good week. Bye.